The dawn of 2026 has brought with it a prevailing sentiment that few anticipated just 2 years ago: a quiet, stubborn resilience. We are not in the booming roar of a post-crisis expansion, nor are we languishing in the recessionary depths so many experts confidently predicted throughout 2024 and 2025. Instead, the global economy has settled into a rhythm of subdued growth, a cadence that lacks the fireworks of a bull market frenzy, but possesses the ironclad durability required to withstand a world in flux. As we analyze the state of the world in January 2026, the data tells a complex story. Global GDP is projected to expand by approximately 2.7% to 2.8% this year. While this figure is technically below the pre-pandemic average of the 2010s, it feels remarkably robust given the headwinds we face. Interest rates have not returned to the zero-bound utopia of the past decade. They have settled into a new neutral around 3% to 3.5% in the United States, forcing businesses and households to relearn the value of capital. The soft landing has, largely, been achieved, but the tarmac is bumpier than promised. To understand this resilient economy, we must traverse the divergence between the robust American consumer and the stagnating European industrial heartland, dissect the show-me phase of the artificial intelligence revolution, and navigate the fragmented geopolitical map where trade wars have evolved into a permanent state of friction. Let us begin with the macroeconomic landscape, which is defined by a world of fragmentation. The synchronized global growth we saw in the early 2000s is a relic of history. Today, we see a multi-speed world operating under the friction of globalization. The United States economy continues to defy gravity, projected to grow at a pace of over 2% this year. The much-feared recession of 2025 never materialized. Instead, the US transitioned into a period of stagflation light, where growth is positive but modest, and inflation remains sticky, hovering stubbornly above the Federal Reserve's 2% target, likely settling around 2.4% to 2.7% for the year. The driver of this resilience is the American consumer. Their balance sheets remain healthier than expected, buoyed by the wealth effect of a stock market that has priced in the AI boom, and a housing market that, while frozen by high rates, hasn't crashed. Furthermore, fiscal policy remains a tailwind. The implementation of the legislative package colloquially dubbed the One Big Beautiful Bill Act, or OBBBA, has injected targeted stimulus into infrastructure and domestic manufacturing, creating a floor for economic activity. Across the Atlantic, the picture is more muted. The Eurozone is forecasting growth of just over 1%. The region is caught in a structural bind. Germany, once the industrial engine, is fighting to reinvent its manufacturing base amidst high energy costs and fierce competition from Chinese electric vehicles. However, there are green shoots. Southern Europe, specifically Spain and Greece, are outperforming the core, driven by a tourism renaissance and cleaner energy grids. The European Central Bank has been more aggressive in cutting rates than the Fed, acknowledging that the old continent's inflation fight is largely won, but at the cost of demand. Meanwhile, China's economy in 2026 is a story of high-quality pivoting. The days of 8% growth are gone, replaced by a managed slowdown to around 4.5%. The property sector continues to drag on domestic confidence, a slow-motion deleveraging that Beijing is managing carefully to prevent systemic contagion. However, the new three industries, solar, batteries, and EVs, are booming, creating a dual-track economy. Beijing's policy for 2026 is clear: stabilize the floor with fiscal frontloading, while ruthlessly prioritizing high-tech self-sufficiency to insulate against Western trade barriers. Moving to the financial regime, if 2024 was the year of fighting inflation, and 2025 was the year of waiting for cuts, 2026 is the year of acceptance. Markets have finally accepted that the era of free money is over. We have reached the end of the last mile. Central banks have largely ceased their obsessive quest to crush inflation back to exactly 2.00% at the expense of employment. There is a tacit acceptance among policymakers at the Fed and the ECB that a stable 2.5% inflation rate is acceptable if it preserves labor market stability. This shift has calmed volatility but raised the cost of living permanently. Prices are not coming down, they are just rising slower. The federal funds rate is expected to settle near 3.25% to 3.50% by year-end. This is the new neutral, a level that neither stimulates nor restricts. For businesses, this means the hurdle rate for new projects has permanently risen. The zombie companies that survived on 0% interest loans are facing a wall of maturities in 2026, leading to a healthy, albeit painful, cleansing of the corporate landscape. We expect a rise in insolvencies among small-cap firms, specifically in the private equity-backed sectors, but this is a feature, not a bug, of a normalized rate environment. This leads us to the labor market, which presents a paradox in 2026. We have cooling hiring demand, yet unemployment remains historically low, around 4.2% to 4.5% in the US. The answer lies in supply. The great retirement of the baby boomers has left a permanent hole in the workforce of the global north. There are simply fewer workers available to fill roles. This scarcity is protecting wages, which are growing at a healthy 3% to 4%, keeping pace with inflation and supporting consumption. However, a new phenomenon is emerging, described by labor economists as a modern Engels pause. This is a period where technological productivity rises thanks to AI, but average worker wages stagnate relative to corporate profits. We are seeing a hollowing out of white-collar, entry-level roles. The junior analyst, the copywriter, the basic coder. These roles are being consolidated. Companies in 2026 are not firing en masse. They are simply not hiring for junior roles, choosing instead to augment senior staff with AI agents. This is creating a ladder crisis for Gen Z graduates entering the workforce this year. Speaking of technology, 2026 is widely regarded as the year the AI bubble either solidifies into concrete utility or faces a harsh correction. Stanford economists predict this will be the year of the AI dashboard, moving from vague promises of revolution to hard, line-item metrics on balance sheets. We are finally seeing the upward slope of the productivity J-curve. In 2024 and 2025, companies spent billions on GPUs and cloud compute, with little to show for it in GDP data. Now those integrations are going live. In healthcare, AI diagnostic tools are now standard in Tier 1 hospitals, reducing administrative overhead by 20%. In manufacturing, dark factories, facilities that are fully automated and require no lighting for human workers, are becoming common in China and increasingly in the US manufacturing supercycle zones like Arizona and Ohio. In software, the cost of production has collapsed, leading to an explosion of niche, vertical SaaS applications. However, the stock market is becoming discerning. The lift all boats phase is over. In 2026, investors are punishing tech companies that merely mention AI without showing revenue attribution. We are seeing a rotation from the hardware makers, the pick and shovel plays, to the software application layer, the companies actually using the chips to sell products. This economic activity is happening against a backdrop of a fragmented geopolitical garden. The landscape of 2026 is defined by active non-alignment and friendshoring. The illusion of a single global market is shattered, replaced by trading blocks. We are in Trade War 2.0. Tariffs are no longer bargaining chips, they are permanent fixtures. The US maintains high walls around green tech and semiconductors. The EU has followed suit with its Carbon Border Adjustment Mechanism, effectively a tariff on carbon-intensive imports. This has forced multinational supply chains to bifurcate. One chain for the West, one for the East. As the US and China lock horns, the swing states of the economy, India, Vietnam, Saudi Arabia, and Brazil, are cashing in. India is projected to grow at over 6%, and is the undeniable winner of supply chain diversification. Apple and Samsung have successfully moved significant capacity to Tamil Nadu and Karnataka. Mexico has seen a nearshoring boom that has transformed the north, with industrial vacancy rates at near zero. Vietnam continues to absorb the lower-end manufacturing exiting China, though it faces infrastructure bottlenecks. The energy transition powering this industry has entered a messy middle phase. The idealistic deadlines of the 2020s are colliding with the hard physics and economics of 2026. The world is investing record amounts in renewables. Solar capacity is doubling every 2.5 years, yet oil demand has not peaked. We are in an all-of-the-above energy market. Data centers powering the AI boom have spiked electricity demand, forcing utilities to delay the retirement of natural gas plants. This tension between AI growth and climate goals is a key theme of 2026 politics. Furthermore, the new oil is copper and lithium. 2026 sees intense resource nationalism. Indonesia, Chile, and the DRC are forming OPEC-like cartels to control pricing for nickel, lithium, and cobalt. For the industrial economy, securing long-term mineral contracts is now as vital as securing interest rate hedges. While the outlook is resilient, the ice is thin in places, and we must consider the risks and black swans. First, there is private credit stress. The shadow banking sector exploded in size during the high-rate years. In 2026, as defaults tick up, there are fears of a liquidity crunch in this opaque market. If a major private credit fund gates redemptions, panic could spread. Second is cyber warfare. With digitization comes vulnerability. The risk of a systemic cyber attack on critical infrastructure like ports, grids, or banking ledgers is rated as a top threat by insurers. Third is the US debt wall. The US deficit remains a concern. While the dollar is strong, the cost of servicing US debt is now a massive line item in the federal budget, constraining the government's ability to respond to future crises. So what are the strategies to thrive in 2026? For investors, the classic 60/40 portfolio is back, but with a twist. Fixed income finally offers real yield between 4 and 5%. Equities should be quality-focused. Look for companies with low debt and high cash flow, immune to refinancing risks. Emerging markets, excluding China, offer the best growth alpha. For businesses, efficiency is king. The goal is margin resilience. Invest in AI not for PR, but to remove manual workflows. Diversify supply chains not just for cost, but for geopolitical redundancy. For individuals, skill stacking is essential. In an AI world, being a specialist is risky. Being a generalist who knows how to wield AI tools is the safest bet. In conclusion, the economy of 2026 is not exciting in the way a bubble is exciting. It is not terrifying in the way a crash is terrifying. It is adult. It is an economy that has sobered up from the liquidity party, paid the bill of high inflation, and is now going to work. There is growth, but it must be earned through productivity, not financial engineering. There is stability, but it is maintained through vigilant policymaking. As we navigate the rest of this year, the watchword is resilience. We have built a boat that can sail in choppy waters. The storm hasn't fully cleared, but for the first time in years we are confident the hull will hold.